Today is Monday, March 6th, and this is the ADM Investor Services Weekly Kickoff. Today's guests are Alan Bush, Senior Financial Economist here at ADMIS, and Steve Freed, Vice President of Grain Research. Alan, the U.S. economy appears to be improving and inflation is accelerating. Does this increase the probability of a Fed funds rate hike on March 15th?
Well, actually, we think it does. There's a very good chance now that the Fed will raise next week. And of course, it's not just here in the U.S. that the economy is improving and inflation is starting to ramp up. It's elsewhere in the world also. So there's a very good chance that we will see the Fed raising rates at their next meeting on the 15th.
The U.S. dollar has underperformed in the news lately. Why is this the case if the Fed is likely to increase?
Well, it looks like currently we are seeing exchange rates already factoring in the probability of a rate increase. Also, it appears that the Trump administration is not that interested in having a strong dollar policy. So if the dollar index were to increase too fast to too high of a level, I think there would be some verbal intervention to take the dollar back down.
After new historical highs were registered last Wednesday for S&P 500, the Dow, NASDAQ, and Russell 2000 futures, prices have settled back a little due to increased probabilities of a Fed funds rate hike next week. Will a rate increase reverse the bull market for stock index futures?
In a word, no. Rates, if they are increased, which we think they will be either at the March meeting or at the May meeting, probably at the March meeting, that rates simply are not high enough to reverse this bull market. So once the rate increase is announced, I think we'll see some stabilization and then another leg up, including new highs across the board in all of the major stock index futures.
Steve, what is the latest on South America and the U.S. weather?
That's interesting. If you look at it from a commercial or local standpoint, you think the weather's okay. It's off and on showers in Brazil that might be causing some delays in logistical moving beans to the port and loading boats. Last week we heard that there was 3,000 trucks lined up in the northern ports to try to unload for the port facilities. If you look in Argentina, the crops have improved from earlier problems. But if they start getting into a rainy harvest forecast, that could slow their crops down or even reduce their crops. And here in the United States, we've had a dry 30 days across the southern part of the U.S. and temperatures have been above normal. It was like one guy in Kansas today said he has to put rocks in his pockets so he isn't blown away. So I still think that it's too early to push a panic button, but certainly wire services are starting to talk about these weather anomalies and try and kind of build up some energy on maybe the upside.
This week, the USDA will release their monthly U.S. and world supply and demand report. What is the market looking for?
Usually March reports are kind of a non-event because we don't really know enough new data to change anything from their annual Outlook conference. And at the end of the month we get some acreage and stocks reports that might be able to fine-tune it. But right now the trade thinks that for the U.S. corn, soybean, and wheat carryout that we might see a little reduction due to higher demand. And globally, we might actually see an increase in global stocks because of the higher Brazil corn and soybean crops. So it'll be interesting to see what numbers the funds focus on. A little bit negative world numbers or maybe a little positive U.S. numbers.
And last week you suggested that speculators and farmers buy the set corn and soybean out of the money call spreads. Why?
I think two reasons. Number one, the option volatility is low, and I think that if we do have a weather problem, that call spread will gain in value as the summer progresses. So especially on a farmer, if he wants to sell his cash and replace it with that option strategy, it's a good hedge against his risk.
There was a report that commodity prices are enjoying their best run in years, fresh evidence that investors are betting on a pickup in the global economy after years of sluggish growth and scant inflation. The S&P GSCI index, which tracks commodity futures, rose 28% last year in its biggest gain since 2009. Many commodities have continued to rally this year. Rising interest in commodities reflects a sharp turnaround from a year ago when these markets fell to historic lows. Commodity assets under management globally rose 7% in January from the previous month to $391 billion, up more than 50% compared with the previous year. Do you think this trend will continue throughout 2017?
Well, I'll let Alan talk about the financials and the currencies, but in the grains, historically, especially corn and wheat prices are low. And so there's value here, especially if we have a weather problem. But I think that the threat of inflation, the threat of better economies has money coming into the commodities again.
And Alan, the S&P GSCI index, which tracks commodity futures, rose 28% last year, and its biggest gain since 2009.
Well, I can add that those trends are going to continue. In fact, if anything, I think we'll probably see inflation rates accelerating, not just here in the U.S., but globally. All the more reason to be long gold and silver. Any type of breaks that we see in those two metals, precious metals, should be used as buying opportunities. And once the Fed raises rates, which will probably be next week, at that point, I think we can see a new leg up and new highs for the move in both gold and silver.
Great. Please remember that the opinions expressed here today are solely the opinions of our guests and not necessarily the opinions of Archer Financial Services, ADM Investor Services, or Archer Daniels Midland Company. If you have any questions or comments or would like to know more about our services, please contact us at www.admis.com.